Hello, and welcome back, guys. So, I was taking a look at some of the well known companies that a lot of people are interested in. One of these is Tattooed Chef, and I noticed that 2 days ago in the previous trading session, remember, yesterday the markets were closed, Independence Day. So, before that, the stock was actually down 47%, and I wasn't surprised that the stock is down because I was expecting that. I made a video about this one and I fully expect it to potentially bankrupt. Then took a look at our news module here, and you will see that Tattooed Chef files Chapter 11 pursues sales of assets. So they are filing for bankruptcy, Chapter 11 bankruptcy protection, and pursue a sale of its assets. So what is going to happen now with shareholders? So typically when a company files for bankruptcy, shareholders more than likely are losing everything that they own, unless the company decides to potentially restructure and give them maybe some warrants, for instance, where they can actually buy stock at a specific time. This is typically what happens, but more than likely, in most cases, people tend to lose all their money, investors that is, even if the company comes back. So even if the company recreates Tattooed Chef with the same symbol, even the old shareholders can still lose all their money. This is how it works after the restructure. Now, I have talked about this company and how terrible of an investment it is, and it is a company that has been boosted by many YouTubers, including Jeremy, for instance. Now, again, people can make mistakes, obviously, but the thing is, and what I've been really annoying about in my channel is the company's money, like how much money the company is generating, how much money the company is making in comparison to their value. I'm not about the hype, because the hype dies down and you could potentially lose all your money, and this is what happened here. Remember, back in 5 years ago, the company was sitting at, like over here, for instance, $25. Insane. Right now it's sitting at almost 30 cents over here, less than 30 cents, being down 47% and pretty much continuing to go down. Now, the thing that you need to be a little bit careful about is when these companies file for bankruptcies and they are basically dead meat. A lot of traders come in and actually play these companies for potential short squeezes, for example, where actually people are shorting the stock, expecting it to go to zero, which will eventually go. But in the meantime, you get traders pretty much trying to short squeeze, and you could get insane moves upwards for a while. Like you could easily see like a 40% up for Tattooed Chef, and then it reaches zero anyway. So this is what happens with these kinds of companies when they go down. So you need to be very careful, and if you are not really knowledgeable about how these things trade, you probably don't want to touch them and not even short them. Like I would be a little bit cautious about this one as well, even though it's more than likely like 99.9% going to zero. So what about this one? So as I mentioned, I was taking a look at the news page of our tool here, taking a look at the chapter 11 and also the short squeeze opportunities, as you'll see what I talked about earlier. This module kind of gives you the whole news here, the news sphere, where you can actually see what is being talked about for the company. I think it's very useful in our tool. But you can see here what the company was doing in the previous year and previous years, and it was either super expensive or basically losing money. And the same with our free cash flow here, getting a little bit better but still losing money. And the outstanding shares again going up again as expected. Now, right now the company's market cap is sitting at $25 million, but I want us to calculate what the company's market cap was back when the company was here, for instance, sitting at $25 back in 2020, about 2020, as you'll see here. So let's, how do we do that? Let's go at outstanding shares here, and you will see that back in 2020 at some point, for instance, the stock was like 35 million, 65. So I'm going to go somewhere in between, maybe 50, and calculate it for 50 as it was going up, down and up. So let's say that the company at some point had 50 million shares, 1, 2, 3, and then we multiply it by $25 a share. And you will see this is 1, 2, 3, $1.25 billion. So the company at some point was worth more than $1 billion. Now, the next thing we do is go to our financial statements, so the income statement, and you will see that the company was generating 85 million. And back in 2020, the period where we're looking at, the company was generating about $150 million. Yet the net income was $65 million. So it was a company that was worth well above $1 billion and was making less than $70 million. So it was potentially more than likely worth like 1.5 billion at some point, or if not more. And so it was making like just $67 million with the previous year being $5 million. So you can see that it was super, super expensive, like really, really expensive for what it was right then. And remember, it is a company that is basically new in the field, first of all, and it's barely making money, and also the margins are more than likely going to be super tight because this is a food company. And this is again, if you take a look at our metrics page, you will see that it is a consumer defensive sector company. So these kinds of companies tend to have really, really low PEs, for example, so they trade for low multiples expectedly because they're not supposed to grow so much, and they don't make great margins. And so this is a company that received a lot of hype. It was hyped up by YouTube and pretty much everywhere. And so this is what happened. So it basically cratered, and right now it's filing for bankruptcy. Now, I don't know if this was a SPAC, but I'm seeing that it was $10 for a long time. So something nearing $10 looks like it could have been a SPAC. So more than likely it has been a SPAC. I can verify that, but it looks almost certain. So yeah, this is what happened with a tattooed chef, and this is why I'm making this video. I kind of wanted to to warn investors about these potential cases, these situations. And you have a lot of companies looking similar to this one. I remember taking a look at Nikola, for example, like Van's company, like the car company, or Rivian was another one. Now these companies may not necessarily bankrupt. They could continue doing well. Yet a lot of people were flocking because the company was a trend and because the company sentiment was high. And if you go back now, for instance, let's take a look at Rivian. Again, we can use the tool and examine all these companies. And you will see here for Rivian Automotive, for example, you take it back 5 years, the company was way, way higher, and right now it's cratering compared to where it was again. Like $20, and it was like 120 at some point. So you will see that this is down a lot. And all these companies, similar type companies, you have to be really, really careful about because they sell at a very, very high multiple compared to what they actually are. So you really, really need to be careful about these ones and not just fall into hype. You want the companies that are actually making money and have multiples that make sense. And we have been talking about these companies in this channel, and I'm making videos as they come up. You want low multiples compared to the company's valuation and compared to how good a company is, of course, because this changes. It depends on the industry and what the company does and all that. But you really, really want to be buying cheap. You don't want to be entering these kinds of companies, again, TDCF here, for instance, where, they are not really making much profit. Again, you can take a look at their cash flow statement, for instance, here as well. And you will see that their free cash flow was basically negative every year. So they're losing money, and people are keep buying the stock and keep buying the stock and keep accumulating. And the company is not making money, so they have to get more debt and more debt. And then all of a sudden they stop selling as much as they were selling because people are moving from this trend, for instance, or maybe they don't have enough money at this current market cycle to actually spend in these expensive, for instance, meals. And so this is how you get these kinds of companies going down. And yeah, these are definitely companies to avoid. And hopefully this video helps you with potential opportunities of this sort, where it actually doesn't really make much sense to keep investing in these. Thanks for watching, guys, and I'll see you in the next video. Bye bye.